Markus Helsing of Alpha Broking. He's in our Melbourne studio. Markus, good afternoon to you. Thanks for joining us on the program.
Good afternoon, Ingrid.
So, obviously, huge moves in gold this week as the uncertainty around that Brexit vote really ramps up. And then, of course, we heard from the Fed last night with rates on hold. So how is that, and a more, I guess, dovish stance going forward, I should mention. So how is that playing in to your views on the gold price?
Well, you know, I mean, people who've watched me over the last few months, they might think I'm like a tape recorder talking about gold and silver going higher. But the bottom line is the technical outlook over the last few months has been extremely supportive, and the fundamentals are just building by the day. So we sort of have the courage nowadays to come out with our long-term targets, because we do believe being long gold and silver is, number one, a hedge against uncertain times and affecting your conventional type investments. But we also think investing in gold and silver and related shares could actually turn out to be a tremendous ripper of an investment. We targeting similar to the Nasdaq, who went from about 800 in the early 90s to 2098, corrected to 1,000, and 2 years later went to 5,000. We're targeting the same type of move in gold. We're targeting $5,000 an ounce in US dollar terms at some point over the next 3 to 5 years.
Wow. Okay.
In silver. Sorry?
Let's stick with gold just for the moment, because I want to get Rudy's view on that. Rudy, you have something to say? We'll get to silver, I promise, Markus.
Well, I would like to see Markus' view, apart from the technical picture. What would be the fundamental view behind gold at 5,000?
Well, Rudy, how much trouble do you have to build up out there? I mean, let's look at the positive side. What can go right here in this world in a moment? What's actually going to really kick the hell out of all the markets and make everything go absolutely honky-dory? I mean, we do have far too much trouble out there.
A stronger US dollar.
Look, I think, see, the US dollar, as a whole currency movements, they might move is in a 10 or 20% range. But I think ultimately I am a big US dollar bear, but not yet per se. I think short term the US dollar does look vulnerable, in particular against the yen and some predictable currencies. But no, I don't think actually that's going to be the story. I think the story is that people are wise enough to realize they have to have some gold and silver holdings to hedge themselves against central banking policies that have reached levels never thought possible only 5 or 7 years ago. So I think that set aside with some serious gearing in the global Western world, obviously, without getting too doom and gloomish, we are very ill prepared for any major accident to happen.
Markus, Scott Phillips here from the Motley Fool. Take the point about the potential for some downside. $5,000 an ounce, though, just requires not only a change in that degree, but to some degree enough of that change all at the same time. We all know that pricing is the imbalance of supply and demand, or the balance of supply and demand, if you like. But to get to that sort of level requires a very significant excess of demand over the current level of supply or availability. That, in most circumstances, is a relatively temporary phenomenon, right? So is this a long-term $5,000, just a $5,000 base? What has to happen to get there? But also, more importantly, how does it stay there, or does it fall back quickly, and is that the time you're going to be selling?
Well, I think, that's a hard question, what's going to do once it reaches this sort of levels. But, I mean, obviously, what you have in a moment, you have a scenario where we have 40 years of credit society that built up world economies to some degree in an artificial way. We have the sort of buy today and pay tomorrow time mentality coming to a finale on every scale, from a private household to corporates and to governments. So really, just imagine, I don't know if you guys imagined in 1990 that we're going to see Dow Jones and S&P levels at levels that we currently trade on. I definitely did not, but I might have just not been as visionary. But I think at the end of the day, it's going to be the exact opposite of what we've seen in the last 20, 30 years of credit-related retail sale type builds. We're going to see the opposite of that happening, and that will affect the likes of gold and silver in a very strong way. It could be a deflationary scenario that supports gold and silver. It could be an inflation scenario. It doesn't really matter, because the monetary policy is stretched to the absolute limit. And hence the risks out there are that significant that it wouldn't take much to see the likes of gold reaching levels that we never thought possible.
So what's your views on, okay, you've mentioned silver as well. Where do you see that one going? Where are your forecasts for that?
Well, that had a record high, $50 or thereabouts, 4 years ago, 5 years ago in 11. And we think silver is the racehorse really in this whole game, and silver could do just about anything. I remember when I was a junior broker in Zurich, people were walking around in 1979 with silver bars all around town. Well, don't be surprised to see that happening very soon again. Look, I think silver could reach levels between $100 to $150 an ounce if we do see targets of gold reaching the $3,000 to $5,000 levels quite easily, and probably much faster than gold. So it is sort of a speculative little racehorse besides gold. So people should definitely, if they have an interest in investing in precious metals, to have a big foot in silver as well, and not just in gold, because the actual gearing of silver in itself, and also the physical underlying supply, actually supports a lot more price rise than in gold itself.
Markus, Rudy again. Just taking this back to the short term, would you agree that if Brexit doesn't happen, that there's probably some short-term downside to both silver and gold?
Of course. Of course, which again will be most likely an opportunity for further buys. But I mean, the one thing I want to mention here, I really do believe, as you're probably very much aware, Rudy and Chris, I mean, and Scott, we have here with Brexit one of the most prepared type of sovereign event. Most likely, it will not be as profound as everyone fears. Hopefully not. I actually much more I'm much more worried about the state of European banks. And I think they could be center stage within weeks. I mean, we have issues from Italy all the way to Germany, and Switzerland as well, by the way. I mean, we have major banks from Deutsche Bank to UBS, Credit Suisse, UniCredit trading at 1980s levels. I mean, this is a very unprecedented scenario. The negative rates in Europe are really hurting these banks, insurances as well. So essentially, we have here, in my opinion, a much bigger problem that could affect underlying gold and silver price down the track a lot more.
Markus, I'm curious. Obviously, these are relatively extreme circumstances. I don't mean you're being extreme. It's just that at the edges, you're saying it could possibly go to these levels if certain things happen. I guess, you know, for viewers watching at home or in their offices, how do you think about the probability of that, and how do you position yourself? Obviously, if it's going to be up if gold is up fourfold in 5 years, then we should sell everything and buy gold. You're not saying it's going to. You're saying there are a range of circumstances where it could. How do you play that, though, in that circumstance where there's such a wide range of potential outcomes and no real ability to put a probability against them?
Well, as I said, first of all, I think the probability of something going wrong in the world economy, I reckon, is past the 65% mark. I think, as I said, to me, gold and silver should be a 10% hold in anyone's portfolio, either in shares or physical gold and silver or a combination. So I'm not saying they should throw everything at it. However, someone who's a bit more bullish than me might throw a lot more at it. But look, at the end of the day, we do believe we are in a scenario that we've never envisaged 40 years ago when Nixon floated the US dollar and got him off the gold peg, and here we are. So this has to be taken a lot more serious than just laugh about. We are in a scenario where central banks, in our view, are in a snookered position, and that is extremely unhelpful for any long-term recovery of the world economy.
Markus, I know Rudy wants to talk oil, but I want to ask you about it correcting in the short term, because you see it going towards $45 a barrel. So continuing sort of this further correction, what's behind that?
Well, look, as a matter of fact, the overnight sort of figures in the US in terms of net reserves should have actually supported prices. But look, I think it's a technical correction. A lot of hedge funds were on this run over the last 3 months. As I mentioned last week, I think it just looks to me like a healthy, classical technical correction down to 45. I wouldn't be surprised to even see the low $40 levels. I think that would be a great level to start looking at going long energy stocks and long oil. As you know, we favoured natural gas a bit more than oil, simply because it was that cheap. It was simply silly not to hold natural gas. We actually took profit out of natural gas yesterday. We are self-critical. We just basically think natural gas could piggyback crude oil and correct a little bit from its advance of the last 2 months. And we look to re-enter at opportune levels.
Markus, Rudy again. The big discussion, I mean, we've spoken about this in the past, is whether if oil does move above $50, that you do get a lot of supply coming back into the market. Are you still of the view that that is not going to break the upmars of oil?
No, I don't think so. I mean, if you follow actually how much banks have been hurt in the US in relation to all the fracking businesses, I think, yes, they will come on, but they will come on in a haphazard way, and they will not come on in a euphoric way like what we've seen when they were booming. So I think once we see $50, $55 broken, I'm very fearful that oil could be once again the sort of the naughty one in the whole financial market, where it suddenly just does something that the world could just not afford. In other words, run to $80 or $100 a barrel at a time when the world couldn't afford it. And I think that's a risk that could happen at some point the next 12 to 18 months.
Markus, curious as to the supply response. Obviously, we know that OPEC to some degree is the one in control of the handbrake, or it's either pedal to the metal or it's handbrake on full, or somewhere in between. They have the ability, the capacity to change that story should they so choose. To what degree does the supply response factor into those range of prices between somewhere in 45 to 80 or 100, as you say?
Look, I reckon if you ever understand what OPEC does and not does, and whoever is disciplined enough to stick to it, I reckon you're a much smarter man than me. Look, I really can't answer this question, to be quite frank. I just would not have a clue. I really go by much more reliable data and figures, like, for example, the demand figures that are out there. They're generally on the rise globally, and obviously what's happening in the US, that's a lot more controllable. I think OPEC is now a fractured sort of a cartel, and I think is slowly losing on importance.
All right, Markus Helsing, we'll have to leave it there, but always a great chat. Thank you very much for joining us.
Thank you.
Markus Helsing there from Alpha Broking out of Melbourne.